Welcome to the Family Banking Show with your hosts Rob, Derek, and John, where we dive into the world of the infinite banking concept and discuss personal banking strategies to secure your legacy and build generational wealth. We're glad you're here, and we hope this episode serves you well.
Welcome back, ladies and gentlemen, to the Family Banking Show. We're your hosts, Derek, Rob, and John. Guys, how's it going this week?
Good. How you doing, Derek?
Not bad. Thanks for asking. John, how are you?
I'm doing well. Coming off a victory. My 2-year-old toddler is officially potty trained. I feel like I can say that right now. So, it's a good time right now.
Yeah,
Life that you can celebrate. But yeah, it's been good.
that's awesome. Congrats.
Yes. Yeah, guys, so this week, obviously, we're going to continue in our series on infinite banking, becoming your own banker by Nelson Nash. This is a good topic, one that is very common for our listeners, for our clients to consider, and it's about rates of return. The section that we are in the book is on page 69 and 70, if you've got a paper copy in front of you. So guys, when a policy owner or future client is thinking about rates of return, generally they have heard, well, whole life insurance offers a terrible rate of return. Why would I want to invest in life insurance? How would you respond to those individuals?
I'd say, first of all, whole life insurance is not an investment. It's you want to think of it as a cash asset. It's like a savings account, a high yield savings account that gives you uninterrupted growth. It gives you a death benefit, and you can leverage that cash value for opportunities, emergencies, whatever you need to do in life. So first, way I always counter that is it's not an investment, but it has very competitive rates of return, better than CDs, and with all the other benefits you get with it.
Yeah, and we're talking competitive after tax, after fees, after all is said and done. What you're looking at, and one of the huge benefits is the tax-free accessibility that you have to the growth, and that growth, like we're talking about, is not a result of a specific investment. And I continue to have to not only remind myself, but everybody I get to talk to on a daily basis. This is quite literally like almost 95% of the time a conversation that I'll have to have with anyone I get to talk to about infinite banking. So I'm very thankful we're at this point in the book where we can talk through it and finally get to talk through, like, the comparison is not even a comparison. Like, if you want to compare, let's talk about a savings account. Let's really dive into the inner workings of a savings account, not, an index or a stock or whatever investment other people want to compare it to.
Right. And speaking of comparisons, one of the main comparisons that people make is, well, I've always been told to buy term insurance and invest the difference. How would you respond to those individuals? How is whole life insurance different? What other products might there be out there that services the need for protection for life insurance? But also, how is it different than term insurance?
Well, first off, term insurance, you think about term insurance versus whole life. It's like renting a house versus buying a house. It's less expensive in theory to rent a house or an apartment than it is to buy one, because you don't have that down payment that you're required. You don't have all the other expenses often that are required, but you also have no equity being built up in your rental unit. And it's a temporary situation. When you're done renting, you don't have the property, you don't have any of the equity. You have to move on and continue, start all over again. And where whole life is, you own the asset. It's a contract. You own the asset as long as you're paying the premium, the guaranteed to pay out the death benefit for your entire life. And it's a flat premium. It stays the same versus term. It keeps on getting more expensive. You could have fixed terms like a 10-year or a 20-year, but the moment that fixed period is over, it gets more expensive every single year. And I should have had a chart prepared, but if you actually look at the cost of term insurance versus whole life, it is so much more expensive for the same time frame. If you're going to try to insure yourself with term versus whole life, that it's not even close how much of a better deal whole life insurance is. So yeah, it's a own versus rent, I think, is a real simple way for me to talk to people about it.
Yeah, and that emphasizes the point that whole life is an asset in and of itself.
Yep.
And I think a helpful way to frame that conversation of the term and invest the difference is if you worked really hard, for 30, 40 years and you're at retirement age and you're ready to retire and your employer were to say, hey, congratulations on retirement. Thank you for all the, work you did for us. Here's $1 million. Like, who wouldn't take $1 million, right?
Mm-hmm.
But on the flip, if they were to say, oh, by the way, you are now done here, but we're going to actually take $1 million from you. Who in the right mind wouldn't be furious at that?
Mm-hmm.
But yet, all this time, like a term and invest the difference, you're building up something meaningful, right? But then at the end, your entire net worth, your asset value drops by the very amount that term insurance was covering you for. So after, in an overnight, you can lose $1 million in your estate or in your net worth. So talk about, a rate of return or a loss of money, that's a huge loss where you can have the same death benefit, not take from your lifestyle, to keep that same coverage that you otherwise would have with term and continue to capitalize on investments. And obviously with infinite banking, we're talking about financing the things of life. So I always ask the question, like, would anybody in their right mind want to just lose, $1 million overnight? And I don't think anyone would. I'd be interested to meet the person that would, but
yeah, that's also the thing that I think, we always talk about think long term. That's what Nelson says in the book. We agree with that. We preach that, it's a mindset, change the way you're thinking. If once you start to think long term, you start to think past your current age, and you start to let's just run the term numbers out till 65. That's like, in the actuarial tables, and that's where it really starts to get expensive, right around that time frame.
Right.
And so the sad fact is that term life insurance gets so expensive right at the moment you need it that people can't afford to continue it, so they drop it.
Mm-hmm.
And like, it's just isn't that a shame? You've been paying for term all this time, and then right when you need it the most, right when your family needs it the most, it gets so expensive you can't afford it. Where if you would have just had the foresight to look long term, you're paying a little bit more upfront. It's a flat fee that never increases, but you're also building cash value that you can leverage at the same time for investments. So it's not an or, it's an and asset, right? You're building up this permanent protection and death benefit. You have this cash value that's growing that you can leverage for investments and for death benefit. Or with term, it's all it can do is just protect you. And then maybe it frees up some cash flow to take some risks in the market, where with whole life plus, smart investments, you get both. You get the best of both. And then when you are at the point when the death benefit will be most helpful to you and your family, you can afford it because you've been paying it for the last so many years, and it's not this increasing cost to you. So it just doesn't make any sense to me.
Yeah, and the other thing to consider is the way that we structure these whole life policies for the purposes of infinite banking is that death benefit is going to increase every single year.
Yep.
So even with term insurance, in order to do that, you would need annual renewable term,
right,
which, as Rob has already said, gets more expensive. The longer you live, the more expensive it gets. Those costs increase, and they're a sunk cost or a lost cost. You can't get that back. There's There's no return on that. And so once that you decide, well, wait a minute, I'm not going to pay $30,000 when I'm 70 years old for $1 million of death benefit.
Right.
Okay, well, now all of a sudden, to John's point, now you're disinheriting your family $1 million because it got too expensive for you. Whereas with whole life insurance, Rob has already said that those premiums will either stay level, but for many people, those premiums decrease over time. The longer you live,
right,
that cost or that premium that year will decrease. Meanwhile, your death benefit has only increased over time. And you, as you guys have already said, you get the cash value component to it. So, and this is unique. I mean, there's very few people that go to their life insurance agent, maybe with one of the major stock companies, when they're purchasing a whole life insurance policy. You may see that death benefit only stayed level, or maybe decreased over time. Well, that's because they're not structuring it the same way we are. They don't know which levers to pull in order to get the features that we're talking about here. So, and the other thing about buying term and investing the difference, that assumption is your investments have increased great enough over your working years that you no longer need that protection or that amount of protection in your passive income years. But why make that assumption when the vast majority of people in their retirement years who have purchased term insurance and invested the difference are, between $250,000 to $500,000 worth of assets? The amount of death benefit coverage that they would have had and cash value available had they purchased a properly structured whole life policy, they would likely have more cash value and more death benefit greater than their total assets or their net worth.
Yep.
Yeah, some good food for thought here. So guys, there in Nelson's book, he talks about this delay, a time delay in the early years of a whole life insurance policy. And he says this is the amount of time it takes to get the banking system established. And this is a one-time only event. It occurs very early on, just initially as the policy is getting started. What would you say to our listeners about that delay in time? How does that affect their potential for investing?
Yeah, so I think it's such a small time window in light of a lifetime, and all the other benefits that you're getting in that short time window. So for most people, depending on the policy and the design, I'm not even going to put a number, but it's less than 10 years. I'll say that you don't get access to every single dollar that you've put into it. Those dollars are going to purchasing your death benefit, all sorts of protections and disability, long-term care, creditor protection, all sorts of other benefits. And for that short window, you are starting a business. You are starting your own personal banking business. And just like, Rob mentioned earlier that, if you want to purchase a property, if you want to purchase a rental property, you have to put a down payment on that. Do you have access to that down payment when you purchase the property? No, it probably takes some time for you to recover the cost of that. And just like any other, actual, business out there, like starting a new restaurant or starting a new e-commerce, whatever it may be, it takes time to become profitable. Those are, in my opinion, a lot more complicated and takes a lot more research, study, and skill to be good at in those different types of businesses. Whereas here, we already have a framework to build our banking business. Just plug and play. It takes 3 or 4 weeks to go through underwriting. You have your policy, and you're ready to start your banking business, which, as we're talking about, just takes a short window of time. Some people can be 4 years, some people can be 8, 9 years, to where then you're sacrificing slight liquidity, and not even that much. If you put your money into a 401k or some segregated qualified account, you're definitely losing access 100% for a very long time. So people are okay with thinking for that, length of time. But for here, we're starting a new business. We're losing slight liquidity, and along the way, that even what is accessible, you're able to put towards opportunities to become your own banker, to finance the things of life and recover tons and tons of interest that people typically pay over their lifetime.
Mm-hmm.
So my next question would be then, guys, do we have any principles or rules or something helpful for our listeners to consider? What might make a good investment if you are willing to take out a policy loan to fund that investment?
Well, I can talk to an investment that I'm doing now. And so I guess I'd go back one step. Nelson says that if you have capital, opportunity will find you. And when you have a permanent whole life policy, you're building up cash value. And eventually, and pretty quickly, actually, depending on what your investment might be, but you have cash value building up that you can leverage. Well, to leverage that cash value via a policy loan, that you're borrowing the insurance company's money, so you have to pay them interest on it. What I like to do is invest it into an investment that's actually paying me back my cost of insurance annually plus. So the net cost to me each year it's a gain. So I'm paying off the interest plus, and then eventually you either pay that off and then you just have X amount of months or years, or you're just getting that cash flow coming in without any cost to it anymore because you've paid off the policy loan, and now it's just free cash flow that's coming in that you can invest or put into another policy loan or whatever, or it's equity that you can then leverage, down the road. But I love that kind of investment because it doesn't cost me anything to leverage my policy loan. And I just think that's a really smart place to go if you have that opportunity and that option.
Yeah. And to get ahead financially, corporations, banks, ultra high net worth people do it and know this fundamental that your dollar has to be efficient. It has to do multiple jobs. We've talked about it already on many episodes in the past. And Rob just alluded and gave an example of how your job is, or your dollar is doing multiple jobs in growing at that internal guaranteed rate of return that's uninterrupted compounding for the rest of your life.
Yep.
And then now you're getting an external rate of return that ideally you feel confident about this investment. That cost of money, the policy loan interest, in my opinion, is really good. It's kind of a built-in valuation to actually understand, okay, is this investment something that I want to do?
Yeah.
Is it going to actually pay me back? Like, am I actually confident in this? And so that's the external rate of return that we all hope for anybody, whether or not they practice IBC. We all hope that everybody's investments do well.
Yep.
And then there's the eternal rate of return, which, Lord willing, we stay on this earth as long as possible. But if not, we're in eternity with Jesus. But our families are protected and getting the death benefit. So those are different types of rates of return. You're also getting a return of your money, not necessarily a return on your money the entire time you're financing the things of life within your policy and not giving up 34.5% of after-tax dollars to interest to banks. So all those rates of return multiplied and continuing to, that volume of return that you're receiving and multiplying your, the velocity of your money truly does put you ahead compared to any other strategy out there. So like if you were to just do the investment, the dollar is just doing one thing. Yep. And that $1 is at risk. It's non-guaranteed. It's giving you no other protections and could potentially result, in a loss, which is the risk behind investments. But here, in starting that sequence with your dollar going a whole life first, you don't have that risk of loss over your lifetime.
Right.
Yeah, it's good food for thought. My personal favorite out, the ones that Rob has kind of already alluded to, just having something that's got a fixed annual rate of return as guaranteed or as close to guaranteed as something could be, that's at least going to cover the cost of interest on the policy loans. And then anything appreciation after the fact is just cherry on top.
Yep. Exactly.
Yeah, good food for thought. Yeah, even real estate investors are particularly drawn to these policies for their businesses and investments. And I think part of the reason for it is they could treat these policy loans like an interest-only loan, right? Where, where else are you going to get money from a bank? Being interest-only might, like a HELOC potentially, but here we're getting it at a much more competitive rate than a HELOC rate. And so they have then that ability to allow the property to appreciate over a long period of time and then pay off the outstanding policy loan, as long as their cash flow is at least servicing the loan interest from the insurance company.
I'd also add to that, Derek, is there's none of the risk because the insurance company isn't going to call your loan in. So if you're a real estate investor and you're using a line of credit to fund acquisitions, investments, the bank might just call in your loan, or they may force you to pay a higher rate of return. That won't happen with a policy loan. And so you get all the benefits of a line of credit, except that you actually get a better rate, a lower rate, and you don't get any of the risk. So it's like such a no-brainer for real estate investors. So if there are any real estate investors listening and you haven't heard of this concept before, reach out, because we will show you how you can get all the benefits of a line of credit without any of the downside.
And it gives you a competitive edge if there are multiple offers on these deals, which anytime there's a good deal in real estate, it's not just you're the only one offering on it. You can take your time. You can wait for the bank to approve a mortgage on it. No, it's multiple people with different offers, with different contingencies, different XYZ, and you can come with straight cash, like from your policy loan very quickly within 2 to 3 business days, most likely, where you can make an offer and have it closed in 7 to 10 days if you want. That gives you a huge edge over other people taking 30, 60, sometimes even 90 days to close on a property.
Yeah, it's a big competitive advantage just to have that ability. And think about, like how many opportunities are real estate investors, passing by because they didn't have that access to liquidity to take advantage of those deals, to do those early signings and say, waive the inspection potentially if you felt so daring. Mm-hmm. And, we're coming in with cash. You could potentially be getting properties at a discount. In today's world, maybe that's not the case, but it has been in the past where a cash offer generally meant that you were paying below asking price, potentially. Yep. Guys, what other thoughts or recommendations do you have for our listeners here when they're considering infinite banking in conjunction with external investments?
I'll just add that this strategy only gets better over time. Yeah. We already talked about the one-time event of capitalizing your system, of building your banking business. And if you start then at year 10, great. Like that is wonderful. You can do it even earlier, but then if you have a good investment experience, you're getting, skill, you're gaining skill in an investment, say it's rental properties and real estate, then just go for the next one, year 14, 15. And that dividend has probably increased significantly. Your cash value is more, and you can probably buy a bigger property or a better, more, nicer property. And then year 20, 25, it only gets better over time. Meanwhile, protecting your family and all the other benefits that we just cannot understate or underestimate the value of.
Yeah, even just thinking of in the book, Nelson talks about an example where the cash value component has that delay in time that we've already discussed, right? And we've looked and, we can demonstrate 8, 9, 10 years. For some individuals, could be as early as 3 or 4 years of kind of that break-even number. But think about, this is perfect for children. The amount of people that put money in a 529 plan or Roth IRA for their kids, great that it's in a Roth IRA, but if you already know, like, hey, I'm not touching this money till they turn 18 or maybe till they graduate college or they buy their first house, right? You've established a long time preference anyway. This is just going to be so much better than those alternatives.
Yeah.
If you're doing it in conjunction with infinite banking and those external investments as well. So it supercharges for children, for minors. This just makes so much sense to put money here first and then take advantage of those external investments as well.
Yeah. Yes, I love looking at child policies because it's just you can just imagine you see the potential, but you kind of like think about their life. Like think about if we would have had that kind of cash value available to us, we were at that age. And if you even look at I love the idea of at 16, if you're a father, you don't have to take out a loan to buy your child a car. They're going to have so much cash value in their own policy that they can take their own policy loan and buy their own car and learn how to pay off their own loan. Like
Right.
it's a twofer because they get to learn the responsibility and how to become their own banker at that young age, and they can just keep repeating that throughout their life. And yeah, I think it's so powerful for children. It's such a wonderful teaching opportunity. It's really exciting to see it.
And that's a part of why we just love what we do. Like we truly do see this not as how we can help people have the most money ever. It's definitely not about that. It's about, strengthening families. It's about, instilling in children a healthy understanding and a high level of financial literacy and understanding of how money works. And that's just by default what happens when parents start policies on kids and they're starting to prepare them for adulthood and when they can transfer these policies. It's just a natural byproduct to instill these values in future generations. Like that's why we have our podcast name is the Family Banking Show, because we just love how this strengthens families. It gives married couples an absolutely better way ahead to feel that finances are fun and not taboo. And then also, just all the generational legacy that can be established through the just learning a little bit and taking action and starting infinite banking. It's really powerful.
Doesn't it also just add a sense of peace in your family because you have these guarantees? It's not like, well, I hope the stock market is up when we retire. Doesn't matter. You have all these guarantees. It takes all of that pressure off, and it removes that layer of stress in your marriage or in your family because you have these guarantees. It's such a big, and then the death benefit, from a wife's perspective, if the husband's a breadwinner or the wife's a breadwinner or vice versa, but if the husband's a breadwinner, the comfort the wife has knowing that if for some reason, God forbid, something happened to my husband, our family is going to be taken care of. That's another layer of stress that gets removed. Like just all of the benefits to a family that this brings is just, it's like you can't quantify it. It's not a number on a page, but it's so valuable. It's what we love about it.
Yeah, selfishly, I wish I'm in my 30s now, still waiting for the news from my parents saying, "Hey, we purchased a whole life policy."
Surprise! Yeah,
that'd be the best birthday present ever, I think, at this point. So,
yeah, I was talking to my dad about, as I've been going through this journey and in whole life over these years and talking to him about it. I could just see him like, oh my gosh, I wish I would have known this.
yeah,
When I was a young father, and I'm like, I wish you would have too.
yeah,
But I could see it. I definitely could see that kind of look of that missed opportunity that when it dawned on him, for no difference in the family cash flow, really, it has all these massive benefits down the road that it's just people don't think long term. Isn't that such a key component? We're so focused in the now, especially when we're young. We're so focused in the now that we never think that far ahead. And that's really the mindset that we're trying to talk about, that Nelson talks about in his book, is think long range. Think there, the days are short, but the days are long, but the years go by really quickly, actually. So yeah, just if you're listening to this or watching this, we just have to encourage you to think long term, and when we can help you see it, we can help you see what that would look like, and it really makes all the difference.
Well, what a good place to end this episode, and to think about next week, where we're going to be talking about the even distribution of age classes, or just legacy planning in general. How does a family really do this across many generations? Grandma, grandpa, mom and dad, kids, grandkids. Like this is where it gets truly exciting for us, and where family banking really can shine.
Yeah.
I hope you will join us in that next episode. As Rob has already said, if this is something that you're interested in learning more about and would like to get in touch with us, you can reach us at thefamilybankingshow@gmail.com, and we would be happy to walk you through this process and to demonstrate for you the ability and the power that comes with becoming your own banker. Guys, we'll see you in the next episode.
You guys.
Thanks.
Thank you for joining us. If you're interested in a conversation about anything we've discussed, you can find our contact information in the show notes below.
And subscribe, follow, and leave a review to help spread this message and to help families across the country discover the generational blessing of IBC. May God bless you, and we'll see you next time.